session, I'm going to talk about the interest rates, which are one of the core elements when I have to look at valuation of derivatives, finding the real worth of any derivative instrument, or for that matter, any financial instrument. If at all I have to talk about the true value, the inherent value of any of the financial instruments, in particularly derivatives also, we look at interest rates as one of the significant stuff. So we really need to understand the different kinds of definitions that are associated with the interest rates, different kinds of measurements that are associated, and how I typically analyze the interest rates. So all these things and the different dimensions with respect to the interest rates, how I use them as a part of the valuations process, all these things is what we are going to look at as a part of this session. So let's get started off. Now, the first thing we need to understand in this context is the different types of interest rates which are generally used for the valuation purposes. The different types of interest rates. Broadly, I see to start with, we work with three different kinds of interest rates. One is the treasury rate, then we talk about LIBOR, and then we talk about repo rate, though there are so many others. Initially, I would like to touch base upon these three kind of rates. But before I even get started into that aspect, when I simply ask you what is an interest rate, we simply talk about two major roles, a borrower and a lender. That particular rate which a borrower will pay additional on the borrowed amount from the lender, that particular rate which the borrower promises to pay to the lender, that is what we call as the interest rate. Let's say the lender has lent $1,000 to the borrower. At the end of 1 year, the borrower pays 105, means the additional 5 that the borrower has paid to the lender is what we are calling as the interest, and this 5 is paid over a 100 that has been borrowed. So I convert it into percentage, it works out as the interest rate for that particular period. Now what we typically see is the interest rate number is different in different contexts. Probably when I am talking about depositing my money in a bank, the interest rate would be different. If I am taking a housing loan, the interest rate could be different. If I am taking a personal loan, the interest rate could be different, because all these interest, the definition is still the same. There is a borrowing and a lending in the process, and that particular additional amount which the borrower is agreeing to pay to the lender for taking the capital, for taking the loan from the lender. But the interest rates are different in each of these cases because of difference in the credit risk that is involved. When I say the credit risk here, we are talking about the possibility that the borrower may default, may not pay the interest and principal on time. So if the possibility of default is higher, then the credit risk is higher. Possibility of default is going to be higher, then we say credit risk is higher, then in that case the interest rate will be much higher, because the lender is taking a higher risk by lending the money, because there is a good chance that he will not get his money back. So what he typically is doing is he is trying to he is trying to increase his expected return. The higher the risk, the higher should be the expected return. So he is trying to increase the expected return, and which is why he is entering into a higher interest rate. So the higher the credit risk, the higher would be the interest rate promised by the borrower to the lender. And that is how the interest rate numbers differ from transaction to transaction. A pure analysis of credit risk, the possibilities of defaults will give rise to what kind of interest rate should be applicable. Now, the first kind of the interest rates which we need to be comfortable with is the treasury rate. Generally, it is the borrowing done by the government. So government borrows on a short term for 3 months, 6 months, 1 year by issuing what is called as treasury bills, or sometimes it could borrow in the long term for longer periods by issuing what are called as treasury bonds. Now, this is the way the government borrows from the general public and investors. So investors lend money to the government. Investors lend money to the government either in a short term or in the long term and in the domestic currency itself. So this does not take foreign currency itself. And we are all aware of this. The government, it's very rare that it will default. Right? Any borrowing done by the government generally is considered as highly secure. Very rare that the government is going to default in any case, and that too in its own currency. So that's the reason we use an alternative word for the government rates called as risk-free rate. We see at a lot of places we would be using this concept of risk-free rate, sometimes denoted as RF. For all the valuation purposes, we will be using this concept of risk-free rate, which is nothing but the rate that is associated with the government's borrowings, with the investment. From an investor perspective, they are called as investment in government securities like treasury bills or treasury bonds. And from a government perspective, it has raised the loan in the short term or the long term by issuing these kind of securities. So, especially for the valuation purposes at a later point, we'll see that there is a possibility that we use risk-free rate for evaluating many securities. But what we are seeing in the practical world is various traders, they believe using LIBOR more compared to the risk-free rate for the valuation. What they typically say is this risk-free rate typically, which is the treasury rates, they tend to be very much low in a practical scenario because of various tax and regulatory issues. So they are not a real reflection of the market. So they don't really reflect the market rate. They are artificially low because of various tax and regulatory reason, and that is where they try to use LIBOR as something that is for evaluating the derivative securities. Typically stands for London Interbank Offered Rate. Now the sentence itself is clear, the acronym is clear. London Interbank Offered Rate. So this is the rate at which one bank is prepared to deposit its money, generally large sum of money, with other banks. So this is the rate. So what is the kind of interest rate which a bank is expecting if it really wants to deposit its money with the other banks? So it's a kind of a borrowing rate So from the other bank's perspective, it is trying to borrow from this bank. So this is also a kind of a borrowing rate, but not by the government here. The borrowing is generally done by the banks here. And the bank which is depositing is actually the lender bank. So the lender bank will actually quote what is the kind of interest rates it is expecting if it wants to deposit for 6 months, 3 months, 12 months, any different kinds of periods up to 1 year, even 1 month, different periods up to 1 year kind of stuff. So these are called as LIBOR quotes. So typically it is seen that compared to a treasury, the banks, the default rate is slightly higher because it's not government, it's a bank which is a commercial setup. The default rates are slightly higher. Generally we see that they are having a credit rating of AA, whereas when we look at the treasury, you can look at it almost as a AAA kind of a credit rating, which means the default levels are almost zero. But yeah, even in this case, the credit risk is much lesser, slightly more than the treasury rate. So what we see is the LIBOR rates are slightly higher than the treasury rates, but from a true realistic perspective, they are much more realistic kind of rates compared to the treasury rate. So that's the reason for valuation of various derivative securities. We see that LIBOR is being used compared to a treasury rate. And all these LIBOR is typically traded in in the euro currency market. And this is one more reason why people tend to use it. It is traded in the euro currency market and no government has any kind of a hold on it. It's not regulated by any government, whereas here it's a government's kind of a borrowing mechanism. So even from that dimension, we see that LIBOR has a lot of importance compared to a treasury rate in terms of valuation. And what we see is if more borrowing of the US, let's say borrowing of a currency is happening, so everything, the rates are market determined. If the borrowings of a particular currency are more and the lendings are lesser comparatively, borrowings of a particular currency, borrowing of a US dollar is more than the lending of the US dollars, then what we see is the LIBOR will increase. Right, borrowing of a currency is more compared to the lending, then we see that the LIBOR for that particular currency is going to increase, otherwise it's going to decrease. So that is one more important interest rate that we typically look at, the LIBOR. And in some cases, the other dimension of the interest rate is also called as a repo rate. In detail, it is called as a repurchase agreement rate. See, generally what we see is a party which is owning some kind of investment securities. It is lending, it is selling these securities to a third party, getting cash, and after some time it is getting the securities back and paying cash. Paying cash and getting a securities back. Now what we